The service inflation you mentioned is 6.1% today actually is still challenging. And that's why I think the message cannot be very strong or actually not much change from last time. That said, the direction is the right one. Data today are encouraging. We are moving towards 2%. I think we'll get below 2% actually very soon. The Bank of England mentioned explicitly that you don't need to be at 2%, but that you move towards that. Conditions are tight. We expect only to become less tight, not easy as such, because you move from very high level of interest rates. So I think these data are actually supportive of a June rate cut. But I don't think that's a message the Bank of England is ready to give today.
I mean, timing can be an issue. It's like heading to the seaside on a hot day. You know where the coastline is, you know which direction you're going, but you can get a lot of traffic, you can get a lot of disruption on the way. It can take somewhere between 2 to 5 hours sometimes. And this is the problem for the Bank of England. Even though we know the direction, timing could be an issue here. If they get it wrong, what are the issues in terms of economic growth collapsing versus unlocking further inflation spikes?
That's exactly the point. I would say that risk at the point are quite balanced in a way, that you can get it wrong from both sides. And because you have rates which are at very tight levels, I think it makes sense effectively to look at easing these conditions. And it's already priced in. And so if you don't deliver at a certain point, I think this will go against activity.
Yeah, is the greater pressure, and it's something that I said to Karen as well a little bit earlier, is the greater pressure coming from the economy, which is weaker, or is it that pressure from the inflation eventually getting to 2% that you're forced to kind of say, well, because of the pressure of the economy, weak economy, we have to cut?
Well, I think it's inflation here, the focus generally for central banks. The point is really that because inflation is moving lower, not moving rates would be equivalent to tighten monetary conditions further. So I think the idea is that you need to accommodate inflation moving lower in order to avoid downside risk to growth from coming up.
So they could risk a recession ultimately in that case?
Absolutely. Monetary conditions too tight for too long would risk a recession. And this is not just in the UK, but generally for all central banks.
Let's talk about the Fed, because we're setting up for what is a key meeting. Investors looking for a lot of clues as to whether they're on track for the 75 basis points for this year. We were debating earlier as to whether one of those rate cuts could actually be wrestled off the table. We could be back to 2 rate cuts, not 3, that the markets had to scramble to try and reassess. What do you think the potential is for that? Is the data suggesting that it's going to be 2, not 3?
It is indeed the risk. Let me put it this way. The fact that 3 dots is very unlikely to be 4 is more likely to be 2. But our base case is that the message and the dots will be left unchanged. The point is that, one, the Fed knew that the path downward for inflation will be bumpy. And I think the reading is that that's consistent with what we've seen so far. The Fed is willing to engineer the soft landing, and this requires them to be, to avoid giving a too hawkish message at this stage. And there are still 3 inflation prints before the June meeting. So I think a bit too early to close the door.
There are a lot